right, everyone, we'll go ahead and get started. This will be a basics introduction to what it looks like to do a loan through an IRA. We've got a couple, two case studies to go through, and then also kind of a primer on self-directed IRAs in general. As this is going to be, again, more of a basics and introduction style webinar, I do encourage clients to ask, or any attendees to ask questions. If you do have something you'd like to get addressed, I am certainly happy to answer it, even if it doesn't necessarily pertain specifically into the general topic of lending and notes within an IRA. So do make sure that you do type in those questions. Again, if you have any questions, keeping in mind that all audio on your side has been muted. With that said, again, my name is Alex Perny. We're going to be going through some basics of lending and notes within IRAs today, as well as self-directed IRAs in general. A little bit about myself. I've been with Advanta since 2012. If you have any questions after today's presentation, feel free to reach out to me directly. I am certainly happy to help you out. A little bit about Advanta IRA. We have over 20 years of experience getting our start here in sunny Florida back in 2003. We are very proud that we administer a significant amount of capital for clients, specifically and only pertaining to self-directed IRAs, alternative assets, things like real estate notes, private stock, all sorts of different and interesting types of assets for our clients, not focused on the traditional stock markets, to the tune of almost $3.7 billion worth of assets for our clients. So we have a lot of experience in this. If you do have any questions, I encourage you to reach out to us. We are always happy to help. We really try to push for a personal touch to everything that we do here. We also have dedicated client account management for any and all clients. If you are going to be doing self-direction, we really try to make sure that you have the knowledge and understanding to be able to do this stuff efficiently as possible and understand kind of how it works and is structured as well. Quick disclaimer before we do get too far in today's presentation: Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So what is a self-directed IRA? The term kind of gets thrown around a little bit out there in the general market, but today we are going to be focusing specifically on self-directed IRAs in the context of them being able to do quote unquote alternative assets. Now, alternatives typically just means something that's not a stock bond or a mutual fund, not necessarily anything that is so esoteric that it's impossible to understand, but really what we like to focus on here, or I should say a lot of our clients like to focus on here, are things that are centric to real estate. It's kind of the main thematic view that a lot of our clients have when it comes to investing. So, direct purchase of real estate, mortgages and notes, private placements, precious metal, cryptocurrencies, real estate syndications, and certainly a lot more. So just keeping in mind when we're talking about self-directed IRAs, that's the general construct of what we're actually going for. Because a lot of people don't necessarily understand what really a self-directed IRA is, because some people, some companies out there actually promote self-directed IRAs as a marketing term strictly for doing things like picking your own stocks. But for what we do here at Advanta, and in the context of this, we are focusing on the alternative side of things, specifically, things like real estate, mortgages, notes, private placements, precious metals, things of that nature. So self-directed plans. So what kind of plans can you actually use to do these types of loans? I'm actually working right now with a client that is going to be doing a mortgage loan out of his HSA. So someone's going to be borrowing money from their health savings account to actually do a fix and flip on a rehab. So very interesting. And the cool thing about any of these types of plans is that while choosing a plan and understanding the benefits that each one may offer you specifically is really where a lot of the focus needs to be. The process for actually doing a loan or investing in any style through one of these types of plans is all going to be the same. So it's very uniform. So once you've kind of decided which type of plan works best for you and which one you're actually going to use, if you have any of these types of plans, you can utilize them to that effect. So again, just like I said, I have a client that's working right now to lend money out of their HSA, which I find specifically very interesting. I personally self-direct my accounts. I have a self-directed HSA, and seeing people actually use those kind of accounts to move forward with these types of investments, I find very interesting. And it's something that a lot of people necessarily don't understand. I think, most people coming into this arena kind of, maybe understand that, hey, my traditional or my Roth IRA can issue a mortgage, or I can lend someone money. But when you start getting into the more less utilized plans that certainly offer a great tax benefit and an ability to really truly diversify your asset portfolio. Being able to do this kind of thing through like an HSA or an ESA or small business plans is incredibly powerful once you kind of have that information. But to the point of what I'm trying to get across to you right now, any of these types of plans qualify, and we do administer all of these types of plans here at Advanta IRA. So for those of you just listening, not looking at the slides, that would be a traditional IRA, a Roth IRA. We can do inherited IRAs, health savings accounts, education savings accounts, solo 401ks for small business owners or sole proprietors and owner-operated businesses, SEP IRAs, and even simple IRAs, and also the Roth variants of those last three as well. So why do people choose a self-direct? That's kind of a very good question to answer, especially if you're coming into this a little bit new. It's a new source of capital. Especially for being able to do these kind of investments. If you're dealing with, let's say, a real estate investor or someone that's trying to get a business off the ground, and you feel that it's a good investment. Well, if you don't necessarily have the funds personally to make that kind of investment, and you don't want to take a taxable and penalized distribution from a retirement plan, being able to utilize these types of plans to make these kind of loans or to do all these kind of alternative investments is an incredibly powerful tool, and something that I really try to push people to really examine is that new source of capital benefit that these types of structures can offer. Also, stock market fatigue. I think it's, although it has been doing pretty well the past few months, it's anyone that's been invested in the stock market since January, and with any type of administration change, there's always some growing pains, but especially right now, I think it's certainly amplified by different things that are going on, and the fatigue of that can get exhausting, right? Again, it's doing pretty well right now, but being able to invest into things that are perceived as being more stable and can offer longer term benefits and that stability is also a really good reason to look at this kind of investment style. And then also, again, the tax benefits. Being able to do these types of investments while not having to take a penalized or a taxable distribution is very appealing to a lot of people, and something, again, that people typically find a very good benefit in when they go the self-directed route. Now, most people typically have some questions pertaining to excuse me, how exactly do you move funds into one of these kind of plans? And is it taxable? Am I going to get hit with penalties? Do I have to do a Roth? Again, a lot of questions are centered around that. So I like to, especially in these basics webinars, kind of go through and make sure people understand, how do you position your retirement plan in order to be able to make a loan? How do you kind of get it there? Because you can't make the loan unless you can actually get things set up correctly and effectively to do this kind of thing. So the most straightforward method is that if you have an existing IRA at any external custodian, is like what's called a direct custodial transfer. Now, this kind of gets lumped in with rollovers, and we'll go over rollovers in a second, but it is a different kind of transaction. So moving funds from a traditional wire clearing house, a big brokerage, to a self-directed Advanta IRA can be done where we actually pull the funds from the existing IRA. There's no tax consequence. There's not even any IRS reporting. It's definitely the cleanest and the cleanest way to actually move funds between two IRAs. And again, no taxes, no penalties, no even IRS reporting is done on this type of movement. So that's the first method. The second method would be a direct rollover. Now, a direct rollover is an actually specific style of transaction, and it specifically refers to doing a movement of capital from an employer plan. So think 401ks, 403bs, thrift savings plans, governmental 457s, collective bargain, pension agreements, those kind of things. You do a direct rollover distribution, and it's a kind of distribution from that plan to a self-directed IRA. Now, it is reportable, it's not taxable, there's no penalties associated, but with a direct rollover, there is a tax reporting requirement. So unless you do have one of those kind of plans, again, if you have an IRA, we're going to do a custodial rollover, a custodial IRA transfer, not a direct rollover. And then the last one is an indirect rollover. So if you've taken a distribution from a retirement plan, let's say you were positioning yourself to do a loan to someone and you're just finding out about self-direction. So you found out about it last month, but you already took the distribution, right? Well, all is not lost, but you do definitely have a clock that you need to be cognizant of. So you have 60 days from the point at which you take a distribution from a retirement plan to put those funds dollar for dollar, penny for penny back into a retirement plan to avoid any type of tax liability issue with that distribution. And again, you have 60 days from the day after you receive it, and you can do an indirect rollover. Some people like to I think, incorrectly term this as being able to take a loan from an IRA. You cannot take a loan from an IRA. Specifically, if you do take funds out of an IRA or a retirement plan in general, again, any type of employer plan does qualify for this allowance as well. Once every 12 calendar months, you are able to distribute funds directly from an IRA and put them back into the same IRA. Now, you can do an unlimited amount of direct rollovers. You can do an unlimited amount of direct IRA to IRA transfers, but this is the only one that has any type of limitation or bounding from the IRS to be aware of. So again, just to recap, you have IRA to IRA transfers where the custodian will pull the funds over. You have direct rollovers, which are going to be when you have an old employer plan and you direct them to send us the funds. Again, no limit on that, but it is reportable. And then the last one is you have indirect rollovers, where if you've already taken money out of a plan, again, maybe for the purpose of needing the capital personally for something like trying to make the investment, right? And to keep in mind, if you want to do one of these kind of investments, you want to make a loan through your IRA, you can't distribute the funds, make the loan, and then roll that note into the IRA. The IRA has to be the one actually performing the rollover. You have to roll in, whatever you rolled out, the actual specifically what you rolled out, if it's cash, has to be returned in the same method that it was distributed to you for an indirect rollover. So rules, what would retirement plans and IRS sponsored accounts be without some rules and regulations, right? So definitely important to understand where these kind of things lie, especially when it comes to lending, as there is some kind of perceived notions that I run into quite a bit with what may or may not be a disqualifying transaction within a IRA when it comes to loans, right? So you have some prohibited investments that you're not allowed to actually own within a retirement plan. You cannot own life insurance, you can't own collectibles. Some coins are available to actually purchase with an IRA, but they have to be basically traded on their content value. They can't be like rare or exotic coins, right? Just straight, bullion content value. Now, prohibited transactions really are where people, especially for those of you that are interested in lending, are probably going to need to really focus most of your attention. So these have to do with the transactional nature of who is actually going to be borrowing the funds, right? So there's people that you cannot lend to. There's people that cannot, be involved directly with the transaction or receive benefit from the transaction in general. So we'll get into that in 1 second. And then again, not necessarily specific to this, but it does kind of creep in, is that there are instances when an IRA borrows money, not when an IRA lends money, that there can be a proportional tax that can be levied to an IRA in that specific instance. But that only applies, again, when the IRA is taking on the encumbrance of the debt, not when the IRA is issuing the debt. And that does come up from time to time. But just keep in mind is that IRAs can lend to their heart's content, but borrowing can be, I hesitate to say problematic, but definitely bears some additional examination to make sure that would necessarily be a good fit. But again, IRAs can lend, but borrowing is where some problems might come in. And again, please, if anyone does have any questions, make sure you do type those in. I know we haven't really gotten too far into the specifics of maybe some stuff pertaining to lending, but do make sure that you type those questions in. If you do have them, I will address them throughout the presentation. So disqualified persons, who are they? What does it mean? So the name of the game when it comes to doing almost any type of IRA investment really boils down to who is going to be on the other side of the closing table. And if you can stay arm's length from your immediate family, so not only just your nuclear family, but your lineal descendants and ascendants of you personally, you're going to stay away from almost any type of issue, and also businesses that you own or control, or any one of these people own or control as well. Now, there are some allowances for lending to a business that you maybe do have an ownership control in, but those rules and regulations get very muddied very quick. It's not necessarily clear where some of those lines are drawn. There are some regulations that the IRS publishes with regard to that. I'm not going to go too far into that today. Want to kind of this is the mark of the spirit of lending out of your IRA. And two, again, it's so case by case that I always encourage people, if you're looking to lend to something that you own or control, like a business entity, trust, or something like that, get with a CPA, get with a tax advisor, get with a CPA, someone that can advise you, because the advice that you might pay for will pay off in spades, as opposed to doing something prohibited in an IRA and having to deal with the IRS on that. And trust me, they don't really have much of a sense of humor when it comes to prohibited transactions and these types of plans. So disqualified persons. Again, directly up and down from you and your family tree and your legally married spouse and yourself personally. Dealing with these people, again, off the table from a perspective of being able to like lend to one of these individuals. Now, these people can partner with your IRA, right? And one of the cool things about lending is that unlike something that's a little bit more of an active role investment, like owning a piece of real estate, or something to that nature, lending, once you kind of set up the loan documents, whether that's just a simple promissory note for an unsecured loan, whether that's a note and mortgage, or something more exotic still, you can partner a lot of people on there, and it really doesn't cause too much of an issue because the money goes out and then it just kind of comes in every month, or hopefully it comes in every month. So you can partner with any of these people, and I've seen it again to the effect where I've had 4 or 5 people with their IRAs and non-IRAs partnered on a note for this kind of investment, and it works pretty well. But just keeping in mind that disqualified individuals can only be partnered with, they can't be on the receiving end of a benefit or the actual capital coming down the pipe for this. Now, once you get one step removed from your IRA, one step removed from this family tree, think brothers and sisters, aunts and uncles, other relatives. Those people can borrow money from your IRA. You can issue them a note. It can be a unsecured personal loan. I'm struggling to think of who actually said the quote, but it's, in God we trust, everyone else brings collateral. You're certainly able to do an unsecured loan, but I think most of our clients typically tend to err on the side of doing secured lending with their IRAs. But again, you certainly don't have to. But if you'd like to actually pursue a loan, again, you can lend to those types of family members or any other people that are one steps removed, are certainly available to do so. And it doesn't necessarily have to be secured. It can be unsecured personal, and you can also do other types of non real estate related security on these things as well. And we'll actually have a case study to that effect here in a moment. So transactions with disqualified persons, what do these things kind of look like? It's easy enough in theory for me to say, hey, don't deal with these people, but in reality, kind of how does that actually work? And again, these aren't all necessarily focused on lending directly, but it paints a good picture of kind of how this works. So your IRA cannot purchase a piece of real estate from your child, right? So IRA buys a piece of real estate from your son. Your IRA owns real estate and leases it to your child. And I actually have a quick anecdote. When I was doing investments for clients many moons ago, back, I hesitate to say almost, I think it was maybe 12 years ago, I was doing this one. Your father's IRA can't lend money to your son. So again, it's not only just like from you up and down, it can actually skip over you generationally to create a prohibited transaction. You also can't, do like a carryback note, like a non-cash sale carryback on a piece of real estate that your IRA owns, or have your IRA be pledged as collateral for a prohibited individual either. Your IRA makes the down payment and you personally guarantee a mortgage. Again, you cannot do that. If your IRA borrows money and is engaged on the borrowing side, can't do that as well. Also, if let's say your spouse owns spouse's IRA owns a piece of real estate and you want to sell your IRA portion of that property, you can't personally purchase that. So again, if your IRA is going to be partnering, let's say on a note, right? You have, let's say, a couple different IRAs involved in a note, and you'd like to divest your IRA portion, you personally can't come in and buy out your IRA, and disqualified individuals also cannot come in and buy out your IRA's portion of the deal. You could have partnered from the onset, but again, that's kind of the nature of the beast. And again, some of these things can become prohibited. You can't lend to a spouse. And one instance that I ran into with a client, it was, kind of funny, again, many years ago, is that had a gentleman that was, pretty active in the local real estate world, had met a woman and they started doing some loans together. She was a fix and flipper and he liked to lend out money. And, they probably had, at one point, I think they had about 5 loans outstanding between the two of them. Well, their business relationship blossomed into a romantic one. They got married, have 2 beautiful kids now. They're still doing great. But the problem was that they still had those loans between the two of them leading up to their marriage. So they had to get creative with having her pay them off back to his IRA before they signed their marriage certificate, because the second they inked that marriage certificate, all of those loans would have become prohibited. So the point I like to illustrate with that is that transactions can become prohibited at a certain instance if your family expands, if you get married or something like that. So, if you deal outside of your kind of personal circles of, either people that are directly in your family, or, again, to that extent, it's kind of hard to say, who you're going to get married to if you're not already married. But again, just understanding that, the validity of a transaction is not going to necessarily be something that is maintained in perpetuity. It can change. So being strategic with actually who you're lending to, how long that loan's going to be outstanding, and understanding that there's really not a divestment path that you can offer to the IRA personally. Again, you could certainly sell an IRA's portion in a note, or sell a note to another investor if, in that case with the gentleman that was getting married, they could have sold the notes. They elected to just, her just to pay them off. But you can sell them to third parties, right? But you just can't kind of personally inject capital into the equation if you're going to be doing something like that. And to that kind of point that I was making, something I really, really enjoy about self-directed IRAs, to the point I was making with the gentleman that got married and had the loans with his now wife, is that you get to use your network to kind of build your net worth, which is something that you really don't get exposed to anywhere else other than self-direction. You can be as savvy of an investor as possible out there, but there's definitely a degree of sterility that comes with investing in stock markets. You can do all the research, you can be as informed as you understand as you can be, but investing in securities, stocks, bonds, mutual funds, again, it's doing online research, clicking buy, clicking sell. You don't really necessarily always you can't always get as much information as you would like, and there's a good degree of faith that you're making in those markets to support share value and stability, and also continued success in what you're actually doing. Now, when you can actually sit down, look someone in the eye, or kind of get to know them, if you will, when it comes to lending specifically, you can get that comfortability. You can understand their integrity when it comes to being able to actually invest with them. And again, certainly, this is not no investment is without risk, but being able to, know and understand the people that are going to be partnered with you on these different types of deals, I feel is a very, very important, albeit a slightly more intangible benefit to doing self-direction, but it's something that I've seen play out to great success for many clients over the years. But the counter to that is that I have seen human nature, kind of rear its ugly head, and I've seen people that have had issues as well. So, understand with any benefit comes downside and risk. And again, the benefit of dealing with people directly is that you get to know and understand who you're investing with. But the downside is that, human nature can be human nature at some point, and problems can and do arise. So making sure that you're doing your due diligence, very pragmatically and very effectively is especially important, because you are giving up some of that oversight and control that things like FINRA and the SEC have on our financial markets. But again, we've seen how it plays out with our financial markets, looking back to 2006, 7, and 8 with the GFC, looking back to the dot-com bubble, savings and loans crisis back in the 80s. So it's, problems can certainly happen there as well. But, avoiding problems is just kind of a different perspective that you have to take with self-direction. And again, what are your choices? We kind of covered this throughout the presentation so far, but again, your choices are kind of what you make of them. So long as that the investment is inherently not a stock, bond, or a mutual fund, we can actually hold that. Now you could lend with stock security, right? So if you wanted to lend to someone, and let's say they didn't have a piece of real estate they were looking to buy, but they had something you needed to do, but that particular project didn't lend itself well or efficiently to having recorded security against it, you could lend against their stock portfolio and have a security agreement attached to stocks and bonds that they have. So the choices for security on these loans is as varied as you want it to be. I've seen people secure loans with a multitude of different things, not just real estate, which is again kind of leads into the flexibility that you have to really structure these types of assets very, very well and suited towards what your goals and needs are. And especially something I like to highlight with private lending is that you get to customize these things to a very minute detail. And unlike almost any other type of investment, is you really get to choose your rate of return with this. And it's, contractually obligated to be paid out like that. Now, again, you do have to be cognizant of rules and regulations that surround lending, right? The big one being usury. There is a certain amount of interest that almost every state has a cap on. And then especially coming out of the GFC, there's a lot of regulations on lending, especially to owner-occupied properties. So a lot of people just kind of, with IRAs, will stay away from the owner-operated space or the owner-occupied space. They typically will lend to people that are, non-owner occupants for investment. Excuse me, for investment properties. Now, to the customization aspect that I mentioned, again, you get to choose the amount that you're lending out, right? There's no prescribed method saying, hey, you have to lend out $5,000 or more from an IRA, or you can't lend out more than $500,000. I've seen people do all sorts of amounts being lent out of their accounts. I've seen multiple $1 million loans, and I've seen plenty of $5,000-$10,000 loans. Granted, those are on opposite sides of the bell curve. There's not a whole lot of the 5,000s, and there's precious few people that are doing more than maybe $1 million out of an IRA. But the customization of these things is quite beneficial to you. So, whatever you have, you could lend out 100% of your IRA on one deal if you wanted to. Typically those people are probably going to be doing things like secured mortgage lending, just for the fact that you're lending all of your money out of a particular bucket. Security can be something that is a concern. But you get to choose the amount borrowed, how much money you're lending out. You get to choose the interest rate. Again, being cognizant of the fact that you do have rules and regulations on things like usury that you need to abide by. So checking with someone or educating yourself onto how much interest can actually be charged on the note that you're lending on is very important, because that's not something that we are going to notify you of. It's up to you to make sure that you peg an interest rate that is going to be legal in the what's the word I'm looking for? In the venue that you're lending in, right? In the state where this is actually taking place, you need to make sure that the interest rates are falling within the guidelines of usury for there. You get to choose how long the note's going to be outstanding for. So if you want to lend on a short-term 6-month balloon note, 100% you can do that. If you want to do a 30-year fixed, fully amortizing loan, you can do that too. And to that point about amortization, you can do things like interest-only loans. You don't have to amortize the note with principal and interest being paid each month. It can be a principal-only note. It can be interest-only. It can be equity participation. You really get to fine-tune this to exactly what's going to make the most sense for your goals and what you're trying to get out of the investment, and also what's going to work best for the person borrowing the money. And that kind of synergy between what the borrower needs and what you as the IRA holder need from a return standpoint can really help to get a very mutually beneficial investment structure that typically lends itself well to being a successful venture in general. So again, just being able to really tune these things to exactly what is needed in a particular deal, personally, I find to be a very attractive benefit to the private lending space. And additionally, something that's not listed up here, but does kind of, come up quite often, is that when it comes to liability concerns, especially people, investing their IRAs into real estate directly, a lot of people that do lending through IRAs, again, are lending in the real estate realm, is liability concerns, right? So not wanting to have an IRA be exposed to liability like you would with a, piece of real estate if you own it, you can certainly have insurance and liability coverage for an IRA, but some people just don't want to deal with that kind of headache, right? But still like the attractiveness of the stability and the tangible nature of being invested in real estate. So loans offer a great hedge on that. Now, understanding that, we can't give tax or legal advice, and, if you have specific liability concerns, absolutely checking with an attorney is very important. But again, someone trips and falls, typically, they're not going to be suing the lender on a property, right? They're suing the owner. So people that, like that kind of hedge against liability, especially being able to be in a position to be exposed to real estate, lending can certainly be an attractive option to try to offer a bridge in that regard. So private lending, what does it look like from a case study perspective? So let's dig in. So Andrea and Steve want to have a joint venture agreement, right? So Andrea has 100 grand and an IRA and just interested in partnering with a rehabber to flip a house. So she meets Steve at a local investor group and learns that he has a project that needs some funding, right? Tale as old as time. Someone has a project that needs some money. Well, how does this kind of play out? Well, Andrea does her due diligence on Steve and the property he's looking to flip, kind of going back to the investing, not only in what you know, but with who you know, right? So she does her due diligence, gets to know Steve. The project seems like it's going to be something that is going to be, working well for her goals with her IRA. They agree to use the property for collateral and some of his own funds. So again, Steve's bringing some money to the table, so he has some skin in the game, and then she's going to hold a mortgage security, a recorded security agreement against the property in this. So Andrea agrees to loan him the rest of the funds. The loan amount includes the funds to purchase and rehab the property. So again, you can include, what scope that you're lending on, right? I've seen people do construction draw loans. You don't have to issue all the funds at once. It can be done in different tranches as well. So what do the terms of this loan look like? So the loan amount's 100 grand, interest rate is 5%, and the equity participation is 1/3 of the profits at sale. Right, again, you can add in other aspects, other benefits and payouts to these kind of agreements that aren't necessarily just, hey, a fixed interest rate. You can have things like profit sharing or equity participation is kind of the term that people like to utilize for this realm. Now, so what does that look like? So the monthly payments are going to be $420, and she holds the first mortgage on the property. So the loan payoff, when this comes around, Steve is ready to sell the property for $130 net after closing costs. Gets a payoff amount from Andrea and the IRA. Andrea is servicing the loan, so she provides a payoff letter and then sends it to the closing and title company for the actual sale. And then the IRA gets repaid in accordance with all of the terms of the note directly through closing. So how does this actually play out on the back end of this? So the repaid principal is 100 grand. So remember, Andrea lent out $100,000 from her IRA. The monthly payments amounted to $2,500 throughout this deal, and 10% of the net profits is $10,000. So within this time span, she has received $12,500 for an effective rate of return over the life of this investment of 12.5%. Easy numbers, right? So Steve's earnings, right? So the original loan's for 100 grand. He sold the property for 130. The repayment of the loan, points and interest, was $12,500, and he made on the deal $17,500. So one kind of gripe that a lot of people, if they're haven't done lending before, is that you don't get exposure to the equity upside when the property sells. You get a very secure position, and you don't necessarily have to worry about fluctuating prices. If the property goes down in value, and there, you still should be getting all of your money back when it sells. Whatever you lend out is your, the outstanding principal is still the outstanding principal, but you don't get exposure to the upside if the property values go up, right? So in this instance, with an equity participation loan through an IRA, you do get some exposure to that equity upside in the event of a sale. Now, the downside to this potentially is that if you're charging less interest, typically these kind of loans would probably have less interest, because of the kicker on the equity participation is that if the property value does go down, you do have the potential to make less money because you're charging less interest, and maybe those profit shares at the end aren't necessarily as much as you would hope for. Now, again, this does kind of lend into a slightly more speculative nature of lending, but I like to include this as the primary case study. So one, having people understand, kind of the basics of, hey, you can lend out of an IRA, you get to choose the interest rate, you get to choose the term and everything, but you can also add in other terms and conditions to a loan that are past just, hey, you have to pay me principal and interest on the first of each month, right? You can get kind of creative with it. You can also use non-real estate as collateral, kind of going back to the beginning of the presentation. Notes can be secured by any number of things, including things that might be a prohibited investment. I've seen people lend and the security was artwork. Right now, that can cause some issues if you default on that loan. Like, how does the IRA take possession? It might need to be something that would have some type of an immediate sale clause, like a liquidation clause or something like that. But the point I'm trying to make is that it doesn't necessarily just have to be real estate. It can be a bunch of different other stuff. It could be a stock portfolio. It could be, I've seen someone issue a note for a guy that wanted to flip a house. For whatever reason, they didn't want a mortgage on the property, so he put a lien against the guy's airplane. Now, I don't know how many people out there that can afford an airplane wouldn't necessarily want to have a lien on property. But again, to illustrate different kind of things that you can utilize as collateral, getting with the borrower to see what exactly that looks like, is something that can definitely help you to tailor these kind of investments that are going to be effective and profitable for you as the IRA holder. Excuse me. So what can this also look like? So the second case study we're going to look at, so Dave invests in Sonia's startup. Sonia's David's neighbor, is looking for a coffee shop in her community. So they speak, they get to know each other. He wants to invest $100,000 of his IRA as a loan to Sonia. They discuss the options and agree to structure it as a $100,000 personal loan to Sonia with an interest rate of 10%, maturing after 12 months, at which time Sonia will pay David's IRA back. She gets the needed capital and generates $10,000 of earnings in 12 months to Dave's IRA. Now, again, in this instance, he could also have security against shares in the coffee shop. You could also do a convertible note, right, where there's an option to convert it to ownership and equity within the IRA at some point as well. Notes are kind of endlessly customizable. Again, one of the reasons I really like them. There's only so many ways to buy a property, right? You have enough cash, or maybe you finance a part of it, you buy it, you own it, you rent it out. Again, there's certainly some creative things you can do with owning real estate, but the accessibility of the scope of options for lending within an IRA is much more pronounced than almost any other type of asset class that we really get much exposure to here at Advanta for our clients. So with that said, actually this slide shouldn't have been in there. So if there are any questions, again, I'm here to answer them. I like to keep some of the basics ones a little bit shorter and sweeter, especially if you're newer to this, getting your head around what self-directed is, doing these kind of investments can be, kind of a lot to take in. I see someone raise their hand. Type your question into the chat box if you have a question, as audio has been muted. So just type that into the chat box, and I am certainly happy to address any questions. If something pops up that you think of at a later date, feel free to reach out to me directly. Phone number, email, and everything are right there on the screen in front of you. So again, if you do have a question, go ahead and type that into the chat box, and I will take it. All right, don't see any questions popping up, so go ahead and end this out. Again, if you think of something that you would like to get addressed, go ahead and reach out to me, 727-754-9954, or Perny, that's APERNY, at AdvantaIRA.com. Thank you very much, everyone, for joining, and have a great rest of your day.